This episode of Macro Mondays aired live at 12:30 p.m. on Monday the 30th of December. Tune in Mondays at 12:30 p.m. UK time to watch Macro Mondays live.
Hello and welcome to another Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
Amongst the charts and trends we'll be discussing this week is the big move higher in US yields we had last week. And we'll also look at the UK where GDP's unexpectedly contracted.
Yeah, we'll look at Bitcoin as well as that continues to make ground and reach all-time highs. And we'll also have a big discussion on the Chinese yields as they are continuing to fall.
So if you start with last week's data, we can see that inflation now is rising again in the US. Both CPI and PPI are moving higher. CPI came in at 2.7%, PPI at 3%. This has to be a concern for the Federal Reserve, and the yields have started moving aggressively higher. The 10-year yield was up 24 basis points on the week. That's one of the biggest moves higher in the last decade. We're also seeing strong sentiment from small businesses. The National Federation of Independent Businesses, the optimism jumped 8 points to 101.7. This is the biggest monthly move since 1980 and now the highest reading since June 2021. This, I think, is on the back of Donald Trump still.
Yeah, absolutely. I mean, he's seen as a business-friendly government. And, you know, I suppose the leading question that we're going to have to be asking is this inflation data coupled with this business confidence going to be influencing the Fed's decisions on rate cuts? Because, you know, if expectations were 2.6% and it seems as though people are very much sort of settling around nearer a 3% inflation rather than the 2% target. So there might be some action having to be taken in order to actually get a grip on inflation, which still seems to be prevalent. And if you're going to be, you know, in a culture of quite high business confidence, then perhaps you're not going to be as you know, cutting rates isn't going to be as necessitous as it might otherwise be in a low business confidence kind of environment.
Yeah, absolutely. We have the Fed this week. They're expected to cut 25 basis points. That's fully priced. But after that, the market's pricing just another 2 cuts. So we're getting towards the end of the cycle. But if yields keep going high, this is going to get priced out. And this could be a risk for 2025. Inflation higher, yields higher. The dollar continues to go higher. Definitely a risk.
Well, and you know the debt that the US is accumulating is always increasing. So you know if the interest rates and the dollar keep going the way they are, this will continue to be a problem, won't it?
And on that, we have the charts of the US 10-year yield. You can see it's clearly trending up again. Paul Tudor-Jones, famous hedge fund manager, he said last week, all roads lead to inflation. I'm long gold, I'm long Bitcoin, I'm long commodities as they're ridiculously under-owned. But as you said, Janet Yellen, the Treasury Secretary, well, she's come out and said, I'm concerned about fiscal responsibility. Deficits need to be brought down. And she, of all people, says that.
I think it's that comment was met with a bit of an eye roll from a lot of speculators and pundits as well. I think saying that being concerned, I think it's fair to say being concerned about fiscal responsibility is, something that very, very much ought to be at the forefront of a lot of people's minds, and I'm sure will be at the forefront of a lot of the policymakers in the soon-to-be Trump administration.
Yeah, and of course, the US have a lot of debt maturing next year. So they have a lot of debt. They want yields lower. That's not happening at the moment. One area of concern, though, is US employment. Job postings continue to fall. Jobs being posted down 38% year on year. So this is the lowest level since September 2020. And permanent job losses jumped to 304,000 in November, up to 1.9 million. This is the highest reading in 3 years. The chart here we have actually is a chart of the dollar. Dollar going stronger, continues to be all-time highs against the Indian rupee, Brazilian real. Also now it's making new cycle highs against the Korean won. So this is, I remember clearly in '97, the Asia crisis. This will be a problem for emerging markets for sure.
Yeah, and as you say, I think it's always worth looking at things like the non-farm payroll data, etc. But not to say that the Indeed job postings will be a perfect measure of employment, but it's probably not a good sign that they're at their lows. And since similar to what we said last week as well, it's the lowest level since March or Feb 2020, or September actually 2020. So mid-COVID. So that's perhaps a hurdle for the US economy to have to overcome.
But again, if you take out government hiring, the private sector hiring is very weak. And that's something that the government hiring is something that clearly Elon Musk and the Doji
seem to be pretty opposed to.
They're going to be hot on for sure. And equity investors are the most bullish they've ever been as the Nasdaq's topped 20,000 for the first time ever. Again, it's trending high. We've said it's expensive. US stocks actually trade at 22 times forward earnings, whereas the rest of the world grouped indices are at just 14 times forward earnings. Maybe one reason why we've seen the DAX surging as we see some rotation out. But for the moment, these equities are trending higher, so you can't fight the price action.
Yeah, since the November election, it sounds as though equities and business confidence have been sky high. Equities also having had a pretty decent 2024 overall, and it just seems to be a momentum trade that's knows no limits at the moment.
Yeah, it cannot go on forever, but for now it is trending higher. And we're seeing actually investment elsewhere. We mentioned rotation into the DAX possibly, but buying spree has moved to India as well. Foreign investors bought just under $3 billion worth of Indian stocks last week. That's the largest investment since June 2023. And on to China. We had some data out over the weekend. Retail sales came in up 3% year on year. It sounds good, but it's expected to come in up 5%. So actually that's quite a lot weaker than expected. Industrial production came in at 5.4% dead on expectations. And actually some strong data, a November trade surplus in China risen to $97.4 billion. But looking at the chart here, this is the Chinese 10-year yield. And you can see not only has it been trending down for 2 years, but actually it's trending down much more aggressively in the last 6 weeks. So this is a sign that the market's not really seeing a reversal in the economic data. Since we had September's huge stimulus, we're starting to see the Hang Seng trend down at the end of last week. CSI 300, the Chinese equity index. So the market is not looking favourably at the Chinese economy at the moment.
Yeah, and on the retail sales side of things, as you say, expectations were around 5%. Last month, the year-on-year data was 4.8% growth, I think. So 3%, while still growing, is a reduced rate of growth, which will be slightly concerning. And I think also there was they have the Double 11 sort of online retail sale that was expected to really bolster Chinese sales, and that hasn't really happened. So yeah, a lot of people have been commenting on worries about Chinese demand for a while, and consumption not being as reliable as perhaps it used to be. So yeah, I think those worries are well founded.
Of course, a huge risk, another risk for 2025 is Trump and the tariffs. We don't know how much he's going to actually implement. It's sort of a bargaining tool to start with, but it's certainly not going to be good whichever way for the Chinese economy if tariffs are increased.
Of course, a lot of their goods that they manufacture are naturally, they have their outlets abroad. And if they were to lose the US market, then I'm not sure that domestic consumption would be able to plug that gap. So that would be, it's purely hypothetical for now, but that would be a serious worry to the Chinese economy.
Yeah, and certainly the November trade surplus, a lot of that is forward purchasing of Chinese products to get ahead of tariffs, possible tariffs. Also out over the weekend, Chinese house prices, these continue to fall, down another 0.2% month on month. That's down 6% year on year. Prices I was reading there's over 70 million empty homes in China. We've discussed before there's over 9 million empty properties in Japan. And we were discussing this just before we came on air. Some people, they bought second, third, fourth as investments.
Yeah.
Clearly...
It's clearly a matter of great concern to the Chinese policymakers and governments. The support of the local housing market was one of the main reasons for the stimulus packages we've seen over the past few months. And whilst that might have mitigated some of the downside, it's clearly not had a total reversal. And you're seeing a lot of houses being unoccupied, you're seeing prices fall. Now, I guess the question is, well, what's the significance of this? Does it just affect the Chinese economy? Absolutely not is the answer. This has wide-reaching impact. Chinese investors have done a lot to support, typically ultra-high net worth sort of housing, but also apartment blocks and that sort of thing in places like London, New York, Paris.
Vancouver.
Exactly. And so with diminishing prices in their domestic market, you're seeing wealth being whittled away at a lot of these real estate investment companies, etc., and their ability, therefore, at the very least, to purchase more housing in some of these Western cities and international cities will be diminished, and so that can have a depressionary price impact on real estate in a lot of countries, UK, US alike.
It's amazing when you contrast this excess of housing with, for instance, Australia, the UK, US, where there's clearly housing shortages. Also in China, electric vehicle sales have surged. More than half of the 2.4 million retail sales of vehicles in China in November were electric. Another amazing fact I found out over the weekend, actually, China now produces 39% of all cars sold globally. That's up from just 1% 20 years ago. That's pretty staggering. And as you mentioned before, that's crippling the German.
Yeah, European automotive manufacturing has been struggling. We analysed that last week, but it's clear that China has positioned itself at the forefront of particularly electric vehicle manufacturing. The BYD seems to be sort of going from strength to strength, and both the US and European countries seem to be scrambling to post tariffs on them because they seem to have such a strong advantage when it comes to electric vehicle manufacturing.
And on to Bitcoin. We discussed last week how it was consolidating around just below 100,000. This morning it's broken higher. It's traded as high as $106.5 thousand this morning. And again, you can see from the chart now, we've had a consolidation. It looks to me like it's clearly breaking out to new highs. If you look at the equities, you look back at famous trading strategies, whether it be Davos or the turtle traders, they would typically be buying these breakout strategies. You'd have trend following algorithms buying these strategies. Clearly there's a breakout here. Again, we were discussing again before we came on air, how do you value Bitcoin and cryptocurrency? It's breaking higher, you can't fight the price action. Where do you think?
Yet again, it's similarly, not similar in every aspect, but similarly to equities, it's very much the momentum is with it. And if you're, questioning the underlying and betting against it, well, you're kind of getting run over at the moment. I think a lot of this will naturally be down to herd mentality, and the herd, you have a fear of missing out, but also you have headline after headline about the Trump government being pro-Bitcoin, and so whether we see these policies come into effect or not, it's kind of in the short term besides the point. The momentum's there, people like what they hear, and so they get into the trade.
Also, as you say, the trend following algorithms they're buying, and it is a real thing, fear of missing out, jealousy of your neighbour, they're real psychological biases we have, which we discuss when we do our trader psychology training. The ECB cut rates last week, 25 basis points as expected. Also, the SNB, the Swiss National Bank, cut 50. The Bank of Canada cut 50 as well. But the ECB also revised down growth and inflation forecasts. And then we had more dovish talk from ECB members. ECB's Kazak said a significant reduction in rates is still necessary. And Villeroy said more rate cuts to come, we're at ease with market projections on future cuts. In fact, the market is pricing another 114 basis points of cuts over the next 12 months. Again, this will have an impact on euro dollar. We can see here from the chart, it's bounced by the previous lows just above 104. But I tend to think, looking at the economies and the price action, it will break lower here and target parity.
Yeah, and I think just regarding the ECB cuts and the SNB cuts, we'd said the SNB were likely to be very proactive. People had been speculating and perhaps pricing in negative interest rates from in Switzerland. So it's no surprise that they've cut. And I think with the ECB, 25 basis points of cuts is the absolute minimum that people were expecting. It's clear that manufacturing in Europe, and not only in sort of peripheral countries, in central, integral countries within the EU, manufacturing and business confidence is not good. There needs to be intervention, interest rates cut, capital expenditure, I think, really needs to happen, and you need to incentivize that by making borrowing cheaper. So that's what they've started to do. I would have thought that's going to carry on.
Yep. And another possible outlier for 2025 is, what if Donald Trump can bring an end to the Ukraine-Russia war, the positive impact that would have on Europe?
Yeah, I mean, speaking about on that, you'd see, I'm sure, power prices. There seems to be, one of the major issues in Germany right now is how expensive power is to produce and to manufacture with. If there was more supply coming from legitimate avenues, i.e. from Russia, at the end of any Ukraine conflict, that would, I would have thought, make manufacturing in Germany and in a lot of Europe more competitive.
Yeah, again, I was reading over the weekend that the power price is going up. They're having a staggering impact on on households, up to something like €2,500 per year increase in costs. UK, we had monthly GDP data come out last week. It came in negative, down 0.1% month on month, expected up 0.2%. More bad news for the Labour Party. We have Bank of England this week. There's nothing priced in. The market's not expecting them to move this week, but they are expecting another 3 cuts over the next 12 months. And actually, just going back to the S&B, the market is pricing negative rates in 12 months' time. But the chart here, this is euro against yen. And actually that's moving, sterling against yen. That's actually moving up. You'd expect on week data that the sterling would be going down. But what you've had last week as well, you've had some mixed data out of Japan. And PMIs have come out weaker than expected. So now the market is not expecting the BOJ to hike rates this week. So sterling yen has gone up, even with weaker UK data. But that's here largely driven by the yen. On that, the BOJ is expected to cut rates on the 24th of January. Market's expecting 20 basis points. So to hike rates, 20 basis points on the 24th of January.
Yeah, just on the UK, to delve into this a little bit, I think negative GDP there, obviously a worrying sign. And it seems as though it's one of the priorities of Rachel Reeves and the new Labour government to try and get some new trade deals and really align the UK with other significant trading members. So the headline coming out this week: Britain officially became the 12th member of the Trans-Pacific Trade Pact, which this includes countries like Japan, Australia, Canada. So it's clearly the case that the UK feels it needs to align itself with other countries, perhaps contextually in this high tariff environment that Trump seems to be looking to promote. The UK will need to be looking for, or sees that it will need to be looking for trade partners with low barriers to entry and that sort of thing, and low amounts of red tape. One of the things that had been considered by Rachel Reeves was reintegrating to some unknown degree with Europe. Now, the rebuttal to this was Brussels will demand the UK to accept its court. no changes to the access of EU fishermen in British water, and Britain would have to accept a youth mobility programme if the UK were to sort of reduce its trading red tape with Europe. So it sounds as though it's not the will of Europe to immediately reintegrate the UK into a sort of EU hybrid trading model.
Excellent. And on to Brent, which remains in its very narrow range, but the last few days it has started to push slightly higher.
Yeah, we saw the headline coming out last week that Israel saw this as a really good opportunity following the collapse of the Assad regime in Syria. Israel defense ministers saw this as a really good opportunity to attack Iranian nuclear facilities. So we saw an uptick in Brent futures prices on the back of this news. They haven't as of yet struck anything, but merely the fact that they are considering attacking nuclear facilities, I think a lot of people price this as being akin to attacking Iranian oil reserves, etc., which is fundamentally bullish flat price. So we saw an uptick, to get Brent futures to around $74 a barrel, $74.50. It does seem as though we're in this low volatility environment, though, and when you see consumer demand in China not being that strong, margins on things like petchems not particularly strong, it does seem to be a limit to the upside that Brent can get at the moment.
Definitely. We also saw more Chinese buying last week. And as we go into the year end, we got 2 weeks. You'd naturally expect volatility to be very low because people aren't going to be putting any new risk to work. But at the same time, volume is going to be incredibly light. So you could actually see some increased volatility there. Silver is now sitting on a support level. Silver and gold, they've been consolidating, going sideways. What we've seen in the last month really is we're seeing a stronger than expected US data. If anything, we're seeing yields going higher, so this works against silver and gold. Silver here sitting on a support level of $30. That was previously in 2020, 2021. That was consistently a peak. You had 4 peaks there, and so it was resistance level before. Now it's a support level. A close below 30 would be definitely a very bearish signal. Again, silver, like gold, has become quite a crowded trade over the last year. Gold is up at one point, up over 40% on the year. So again, as yields go higher, that would be certainly a negative, and that's one to keep an eye on. Central bank pricing for the next 12 months. We've mentioned we have the Fed this week coming towards the end of their cutting cycle. We have the BOJ expected to hike now in January. Other central banks, we had big moves this week, which we mentioned. Which brings us on to our last chart. Again, a very crowded trade, lots of market longs, asset managers, funds, very long of NVIDIA. You can see here, this looks like a classic head and shoulders pattern, but it's not a reversal unless the support level of $131.8 breaks. If that breaks, then you're likely to see an aggressive move lower. Say it's crowded with longs. That's the key support. That's where stops would be set. That's one to watch because equities have had such a bullish year. On to this week's data. On Tuesday, we have US retail sales. Wednesday, we have the Federal Reserve. As you said, the market's expecting them to cut 25. Thursday, the BOJ, just 4 points of hike is priced in, but the market's expecting the move to be in January. Thursday, we also have existing home sales, which will start to get more focus, as we've discussed, potential weakness there in 2025. And on Friday, PCE inflation data. That's one of the Fed's favoured measures. So that brings us to the end. This is the final Macro Monday of the year. We'll be back the first Monday in January. So we wish you a Merry Christmas, a Happy New Year, and we will see you in January 2025. Thank you.
Thank you very much.